Good day, everybody. Good evening. Please, if you can hear me, let me know. Can you hear me, please?
Yes.
Live.
Good evening. So today we are starting. I'm trying to share my screen now. We're starting. We're continuing from where we left, where we stopped last time. Can you see my screen now?
Yes, you can.
Yes.
All right. This app is really powerful. Yes, it's a lot. Can you still see my screen?
Yes.
Yes.
All right. Good evening, everybody. So today we are going to technical analysis in depth. We are starting technical analysis, and if you can remember, I in the last class I said that there are three major ways to analyze or forecast the price movement, and I said that we have technical analysis, which talks about compiling the data, like using the past to predict the future. I use the illustration of someone that usually wakes up by 6 a.m. So if someone has a data or a record of you always waking up by 6 a.m. by 6 a.m. So it's like a data. So and there is a pattern in that data. So they can use the pattern in that data that they have to predict the time that the person will actually wake up the following day. So that is what technical analysis is about. We use past data, we use price patterns that has happened in the past to predict what is going to happen next in the future. So in technical analysis, how does market behave? Because technical analysis, you will learn how market behaves, and we have two major ways that market behaves generally. The market behaves in two major ways. We have a range or sideways market behavior, and we have a trend market behavior. And what do I mean by that? I think I will try to explain when we get there. A ranging market is a market where the currency pair moves back and forth between a price range of high price level and low price level. If you can see the diagram that is beside dis words, you can see that we have a red line at the top and a blue line at the bottom. So and then we have something like a chart going back and forth in between the red and the blue line. So this is what a typical ranging market looks like. It will be going back and forth in between a price, and honestly this thing happens in our physical market in the world. You know, um let's say the price of, thank God most of us we are Nigerians, let's say the price of a congo of rice, it can be between, some people say it is 2.9, some people say it's 2.5. So the low price, this blue line looks like the last price, like the cheapest price where people start buying from. And then this red line looks like the highest price someone can desire to patronize the market. So the 2.5, if we are to use the price of congo of rice for example, we will say okay the 2.5 will be the one at the low, which is at this blue zone, and then the 2.9 will be at the top. So when price is going back and forth between those two lines, we say that we are in a ranging market, and this thing usually happens in the forex market and also in the physical market. Please can you mute your mic please? So now let's move on. We have another type. You know, the first one we say we have a range or sideways market, and then we have trends, that is a market that is trending. So, and I've explained a ranging market. This blue line, maybe to make it more understandable, um I can call it the last price, because when people go to market they try to bargain, say dele dele, what's the last price for this market? So it's that blue line. And then the red line is like the highest price that nobody wants to buy it above that price. If they say the price is a little bit above this place, nobody in the world wants to buy the market above that line. So and then in between there is something that people that are in the market they really know, that in between there is they call it, in a technical term of the forex market, they call it the control price of the market. And what does that mean? It's like the price, the normal price, like I'm trying to use a layman language to explain it. Like there is délẹ̀ délẹ̀, there is ó ti wọ́n jù, then there is normal price. In between is always in between, is always ranging, is always between the highest and the lowest price. Please, are we still together?
Yes, sir. We are together.
Alright. So then the second kind of market, we said price moves in a range or sideways. Another word, another term for range is sideways. And then the second one is trend. What is trending market? A trending market is one where prices are moving in a single direction, either up or down, but not sideways. That is, it is not ranging. What do we mean about that? It's when price is moving continuously towards a direction. It's like the price keeps going up. It's like, maybe I can use somebody, you have not muted yourself. We can, your mic is making the noise. Please try to mute yourself. And then um for example, the price of, let's say, petrol or dollar to naira in Nigeria is like in a uptrend somehow, because it's like it's just going towards a direction. It's just going towards one direction. It keeps going up, keeps going up, keeps going up. So when there will be time that the market will retrace, can come down a bit, then go back higher. When price is moving towards a direction, either higher or lower, then we can say the market is trending, is in a trending market. And the second point says that there may be several small price gyration, but nothing large enough to impact the general direction of the trend. Trend can last for minutes or hours or weeks or even months. E can even last for years. Like the price will just keep on increasing, 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 or keep on decreasing, 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 depending on the pair or the stock or the market that you are trying to trade. So we have a trending market. That means we have two types of trend. The two types of trends, we have uptrend and then we have downtrend. So what is uptrend? An uptrend is overall, in an uptrend, the overall price moves higher and it creates higher highs and higher lows. I will explain what that means. And then a downtrend is a series of successively lower tops and lower bottom which create downward pattern on the price. Is, we said is a pattern. Data, when you have a data, it will always have a pattern. Even people that are into a data analysis, they understand this, that if you have data, you can you can create a pattern from your data. So in the market, we have data. The things that is showing on the price that you are seeing on the market is you can collect data, and inside that data you have a pattern. So what they mean by uptrend, please can you see my screen? Can you still see my screen, please?
Yes.
Please can you still see my screen? Are you there?
Yes, we can.
All
Yes, we
right.
can see us.
All right. So in uptrend, this picture shows that the market will keep forming higher high. You see, the market is going up, down, up, down, up, down. You see that each time it goes up, when it goes up, the new highs that is formed where they wrote this higher high, it is above the previous high that was before him, that was before this high. So we see this market is going up, is in an uptrend because we have higher highs. Higher, this high is higher than the previous high. This second high is higher than this previous high. And then this last one is higher than the previous one. So it's like the price is increasing, is increasing higher and higher than the previous. Is like I don't know how to explain. Like, okay, now this ranging market that you have, when you see that the price is superseding the last price where nobody wants to buy it before at that price, so then next time you just see that price now goes above it. There was a time that you even see Twitter posts, they be like, dollar is now 710, can you come, let's do something about it. And they feel like if during that time people might be like 710 is too expensive, people might not be able to buy it more than 710. So when we now have price going above that 710, is now crossing 800, is now crossing 1000, it shows that we are now in uptrend because the high, the current high supersedes the previous high. So the same for downtrend, market will be forming highs and lows, this high. So can you see my mouse, please? Can you see my
Yes,
mouse?
we
Yes.
can.
All right. This
Yeah.
high, this is low. So when the new high is lower than the previous high, it means that the price is falling. Please excuse me. I'm back. Please. Are we still together? Please, can you still hear me?
Yeah, we are together.
All right. So for a
Yes.
downtrend, we see market forming a high that is lower than the previous one. That is, price keeps falling down. Is a pattern in the market. It is obvious. Whenever you open your price chart, you will see it. You will see that market can be going up like this. That the new high will be higher than the previous high, and the new low will be higher than the previous low. So it means that in uptrend, what do we have? We will have, maybe I should try and write. In uptrend, we will have, try and jot it down. In uptrend, we have higher highs and higher lows because the new high will be greater than the previous high, and the new low will be greater than the previous low. So higher highs and higher lows is what we will have in uptrend. And then for a downtrend, we have lower highs, this new high will be lower than the previous high, and the new low will be lower than the previous low. So in uptrend we have higher highs, higher lows, that is HHHL. And for downtrend we have lower highs, lower lows. It will be LHLL. Lower highs, lower lows. Please, do we understand that? Are we still together?
Yes, sir. Together.
All right. So generally, this is how price moves. You can see from this picture, you see that markets forms from A to B. They call it uptrend because it is going higher, forming higher high, higher low, higher high, higher low, higher high. And then B to C, they call it sideways. That is a ranging market. That is, market will just be going back and forth between two price, back and forth. And then the C to D is um downtrend, which is we keep seeing lower highs, lower lows, lower high, lower low, just like that. Can you see it? So generally, price obeys the law of demand and supply. The higher the demand, the higher the price, and the lower the demand, the lesser the price. What do I mean about that? When there is demand, when a lot of people are demanding an asset or a commodity, it will cause the price to go up. Market will always go in the direction of the majority. It means that, okay, take for example the common illustration I used to use is during the outbreak of coronavirus, that there is an announcement that we should all be using nose masks. So during that time we saw that one nose mask, I think they sold it like 1,000, 1,500, just one nose mask that time, because there was so much demand on nose masks that a lot of people, they cannot allow you to enter bank, they will not allow you to do some things if you don't have your nose mask. And a lot of people, hand sanitizer, it was very very expensive during that time because there was a lot of demand on it. Demand was on it, so it caused price to move up. And then e now got to a point that people now started improvising their own nose mask. You see someone, they can actually tie their handkerchief around their nose and use it as nose mask. Some people use some cloths and they just join it together and put something like handle on the edges and put it on their ears. That's their own improvised nose mask. When there was lesser demand, when the demand on the nose mask has reduced, it caused the price of the nose mask to also fall. So that's what I mean by the higher the demand, the higher the price. So it means that for price to go up, it means that a lot of people are demanding it. But it does not necessarily mean people, because price is always going towards the direction of people that where we have the biggest money is where the price will go. It does not necessarily mean people. 100,000 people can want to buy an asset with 100,000 naira, and then just one man, maybe like Elon Musk, just decide to buy that same thing with $1 billion. So 100,000 people using 100,000 naira, and then one person using $1 billion, market will go towards the direction of the bigger fund. So the higher the demand, that's the higher demand. It's not in terms of people, it's in terms of the money, of the liquidity, of the volume of money that is being pumped into the market. So the market will go towards that side. So the higher the demand, the higher the price, and the lesser the demand, the lesser the price. So that's the third point that is trying to explain that if more people want to buy a stock, that is, they demand it, than sell it, more people want to buy it than people that wants to sell it, then it means that the price move up. And conversely, the price will go down if there are more people that wants to sell the asset. Please, are we still together?
Yes, sir, we are together.
All right. So now, I don't know if any of us has seen the forex chart before. We see that I was saying that data, when you have data, you have is you can get pattern, you can derive pattern from the data. So the chart is always printing data every time of the day. The forex chart is a digital chart and is always printing data, and it is from those data that we try to find out pattern that is common. Okay, maybe when I see this is what happens. When I see this is what happens. When I see this is what happens. So it's a pattern in those data. And the forex chart is always telling us a story. The stories are written in form of different kinds of pattern. And the most common and easiest understandable language is the Japanese candlestick. Whenever maybe you have seen the forex chart before on someone's phone or anything or any advert, you see that they will just draw series of candles, green and red, green and red. It could be white and black, it could be blue and red, and it could be like something like curves, like this one that we have here. It could be like this. So they are always telling us story. And what's the story? So the green candles, we have two colors. We have green and red color candles. So the green color is signifying upward price movement. Is signifying bullish. If you see under it, e wrote bullish. And then bullish means up. It means buy. If they say the price is going bullish, it means it's going up. They say there are more buyers, it means the price is going up, it's going higher. So for red candle, it means bearish. Bearish means selling. It means supply. So it means that price is going down. It means selling. It means supply. It means lower. So each candle has an interpretation. So if you see a candle, when I say green candle represents bullish candle, it means that the price is going up. The price of the candle is going up. So the open, if you can you see this diagram please, where they wrote open, close, high, low, because this you need to understand.
Yeah.
Yeah. So now where we have open, close, high, low. So now for green candle, the open will be at the below at the lower part, and then the close will be at the upper part. It means that because green candles represent a buy candle, it represent up candle, is always going up, is always going up whenever you see green candle. It means that the opening price, the price, don't forget that in the forex chart we have um the data that is printing price against time. So the price will go from this open and it will go and close at this close here. So for a green candle, the open will be at the lower part and then the close will be at the higher part. So these lines that is above it, they call it wick. They call it candle wicks. So if you have the wick under the candle, they call it low. This extreme extreme end of the candle wick is called the candle low, and the extreme top of this candle wick is called the candle high. So we have for green candle, the open will be low here, lower here, and then it will be lower than the closing price. So the closing price will be above, the opening price will be below. And for a red candle, I said red candles are always going down. They are always going down. So it means that they will open up, their open will be above, and then their closing price will be below. So their closing price will be lower than the opening price. That's why it is a red candle. So their eye will be up here and then down here. Please, do we understand? This is the foundation for technical analysis. It's foundation, and everything I've been saying, you need to really have a good understanding of it if you want to really understand how to analyze the market. Do we understand this explanation of candlestick, please?
Yeah. Yeah.
You
I'm
understand?
first. Let me just say that I'm trying to get it.
You are trying to get it. Okay,
Yeah.
I will explain again. We understood to the point that, okay, price candles are always seen on the forex market, and those candles are always usually in two colors, green and red. So I said green candle represent bullish or buy or up. So whenever you see green candle, it means that people bought. Is, I said the forex chart is telling us story. So um the story is, when you see green candle, it means that there were a lot of buyers at that particular time. So that was why the candle that you see on the chart is showing green. So whenever you see a red candle, it means that there are a lot of people that is trying to sell the commodity. That's why you see a red candle. Please, are we together?
Yes, we're together.
So for open of a green candle, I said for green candle it means up, it means bullish. So it means that the price that you open it will be low, ó máa wà nísàlẹ̀, it will be cheaper than the closing price. It means that the opening price will be under, we open at this lower part, and then it will close, because don't forget that this close is a price and this open is also a price. And if you normal graph, the small digit will be at the lower part. If you draw a graph, you have 0, 1, 2, 3, 4, 5, just like that. So the lower part, this price at the open will be lesser, and this price at the close will be higher. If this is a naira, this place can be maybe 800 naira when it opened, and then it's now closing around maybe 950, 850. I'm just saying, this is a price, this open is a price, and this close is also a price. So the opening price for a green candle, because green candle means there are a lot of buyer, that price went up. So if price went up, it means that it went from below to up. So it means that the opening price, the open will be here, and then the close will be above. The price where the candle closes will be higher, will be expensive than the opening price. And for a red candle, the opening price will be at the top, and then the closing price will be at the bottom, because for a red candle it means that people sold. So it means that the closing price will be lesser than the opening price. Please, do you understand? Because this is
Yeah,
the
yeah.
foundation.
Yeah, I understand.
Is there anybody that understood this explanation?
Yes, I got it.
You got it.
Yeah.
Anybody else that do not understand this? Because I'm trying to break it down so that it will not be too complex for us to understand. I'm even thinking I should not go too far tonight and just maybe pause here, because there are a lot of candle patterns. I said that on the forex chart we have different um stories that is on the chart, that is printed on the chart in form of candles, and those candles they have patterns, and we have different candle patterns. So I think for now maybe I should stop here, so that next class we just go into the in-depth of the candle patterns. There are common candle patterns that you will see on the chart. You can see some they can have they can look like hammer. So people have named the candles and what and the interpretation they mean. So for green candle, the interpretation is there were more buyers in the market. So the open will be lesser than the closing. And for red candle, it means that there were more sellers than buyers. So it means that the close will be lesser than the open. So it's just like that. Then next class I can go ahead and then explain the candle patterns, the series of candle patterns that we have, and then their interpretation. Or maybe I should go to the a live chat and then show us something. Please, can you still see my screen? Can you still see my screen, please?
No.
Yeah, I can see the screen now.
All right. I feel the best for now is to just go over the class, what I've just explained, and then uh, next class we'll just go into the candles, the explanation of the candles and their interpretation, and then explain some important, very, very important points to us. And afterwards, if I now explain my strategy, you will be able to comprehend what I am trying to say. So today, can you still see my screen? Are we together?
Yes, we are together.
All right.
Yes, we are together.
So today, what we have done is we explain how price moves. It's just like market will always, the way price moves is it will be in a range. People will be buying and selling at that price range. Before there was a time that maybe I should explain this way. There was a time that a Congo of rice, sorry I'm using rice, I feel that's what most of us can relate with. There was a time that maybe a Congo of rice was at 1.5, and people were saying that 1.5 is expensive oh, and is below 1.5, is just going back and forth, maybe 1.5, 1.3, 1.5, 1.3, 1.5, 1.3. So market is ranging, and then all of a sudden it will break out of that range. It can start going up or start falling down, or out of that range. It can be between 1.5, 1.3, 1.5, 1.3, 1.5, 1.3. Then all of a sudden, boom, 2.5, 2.9. Then it started forming another range. 2.5, 2.9, 2.5, 2.9, 2.5, 2.9, 2.5, 2.8, 2.5, 2.8, 2.5, 2.8. And then we don't know. Another thing can happen again. It can break out of 2.8 and say 3k 3.3, 3k 3.3, 3k 3, and then or it can start going down. It can go back to maybe 1.8, 1.7, 1.8, 1.6, 1.8, 1.6, like that. That's how price behave. Even in the forex chart, it goes from a range to from ranging to trending, then to range, just like that. So that is what a ranging market are. A ranging market is when price is going back and forth between these two prices, and then you can, if you can see this structure, you see this thing they call, they wrote breakout there. So price will range, then it will break out, then it will range and then break out, it will range and then break out. So that is just what we have done today. And then the trending market, we have two types of trend. We have uptrend, we have downtrend. We have, sorry please, let me attend to someone here. Sorry, I'm back. Are we still together?
That's better.
All right.
Yes.
So today we've learned sideways, that market goes from ranging to trending. So that is what market does. It goes from ranging or sideways market and then a trending market. And then we have two types of trend. We have uptrend and a downtrend. And for uptrend, we said that price always goes from it keeps forming higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. And then in a downtrend, we have market forming lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, just like that. And then we discussed that price are always uh, printing something on the chart. They are always telling us story. The forex chart is telling us story, and the story they are written in form of candles. That's the ink. That's the way the story has been written. And then we have two types of candles. We have the green candles. We have green candles and then the red candle. What's the green candle telling us? It's telling us that there are people buying, more people buying, and then for a red candle, there are more people selling. So for a green candle, the open will be at the lower part and the close will be at the upper part. And then for red candle, the open will be at the upper part and the close will be at the lower part. And that is just the summary of what we have learned today. And one more point I did not mention is that price will go towards the direction of where you have the greatest volume. So if there are more people that wants to buy a stock than people that want to sell it, then it means that price will go up. And if there are more people that want to sell the stock than people that want to buy it, then it means that price will go down. So the higher the demand, the higher the price, the lesser the demand, the lesser the price. So that's just the summary. This thing that I've explained is really, really important. It's really, really important that price goes from sideways. It will be ranging and then it will break out. It can break up or down. And then if it will now be trending, it will now be going, forming higher high, higher low, higher high, higher low, or lower high, lower low, lower high, lower low, just like that. So if you understand that, then you are like 40% are close to understanding technical analysis fully. You are 40% close if you understand everything. You see, I'm trying to make it short and I don't want to bore us. So next class, I'll just go into the in-depth of candles, because since all we are going to be seeing on the chart is are candles. So it means that we need to understand the candles in depth. So we are going to the in-depth interpretations of candlesticks. So when we explain that, then we will now go into the strategy and then we are done. We are done. So all you now need is just a constant practice of what you have learned till your mind can fully grasp what I have explained, and then you see how it's working and you enjoy it. Is there any question before we round up for today?
Thank you. Thank you, sir. I have a
You have a question?
yes, yes.
All right. Please ask your question.
All right. Yeah, you why explaining you said for the green candle it means more people are buying.
Yes.
Then for the red, more people are selling. Yeah, in
Yes.
layman's word. Okay, so my question is for those trading, like I use myself as an example. So I'm part of those that are trading. Will my choice of what I pick also, will it affect the market trend?
I don't get the question clearly. Like you are part of people that are trading. Your choice, will your choice affect the market what?
Yes, market trend. Like will it affect where the where the market will go? Like okay, in my own mind, I feel maybe those that are putting big money
Yes.
into the things they are the one that really control the trend. So will my, for example, will my $1, $2 also affect the
No,
market trend?
it doesn't. Um it's just that I don't want to make it complex. But people that really control the price of the market are big. The examples include commercial banks, central banks, hedge funds, big private companies that are so big, people rich investors, people that have big pool of funds. So I said that the price will go towards the direction of where you have the bigger pool of fund. So your money can add to their money, but your money alone cannot move the market. $2, because the truth is the turnover or the volume of money that goes back and forth in the forex market is like $6 trillion daily, on a daily basis. Like 6 trillion, 6.6 trillion, like five, let's just round it up to $6 trillion according to data. If you go to Google and search it, you will see it there. That is like about 6.6 trillions of dollar daily, on a daily basis. So our own $2, $5, $100, $1,000, $20,000 has nothing to do with trillions. So it cannot really move price, but it will just add to the number of people that are buying or they are selling. But our money doesn't move price, because the higher the demand, wherever you have bigger pool of fund is where the price will go. If a lot of people let's say out of the 6 trillion, um maybe 5 trillion wants to buy, not people, money. 5 trillion was used to buy an asset, and then 1 trillion for selling it. Definitely market will go towards the buy side, because there are more buyers than sellers. That's why the price will go up. So if it's vice versa, if you have 5 trillions for sell, 1 trillion for buy, so price will go down, because 5 trillion volume of money is selling, so it will go down. So that's just our own contribution. Small small money does not really cannot move price, but it's just adding to. So the best as an investor, that's why we are learning technical analysis, is to understand where they are trying to push the price, where price is going, so that you can join it. It's like you want to catch a moving vehicle. So if you want to catch a moving vehicle, you know that you need to be extra careful. You need to look for a place that you feel like, okay, this market or this vehicle will slow down a little bit here, so I can jump in here and then up out here. So It's like you want to catch a moving vehicle. That is how retail traders, because retail traders are traders like me and you, that are using our small small money to trade with the expectation of making profit. Please, can you still hear me?
Yes, you can hear you.
We can hear you.
All right, all right. So, is your question answered?
Yes, yes. Thank you very
All
much.
right. So, is there any other person that has a question before we call it a day? Any other question? All right. I will assume that we all understood. And today, price goes from range to trend to range to trend. It's range, trend, range, trend, range, trend, range, trend. That's how market behaves. Range, trend, range, trend. We start from a range. People will be buying and selling. So even when we get to deeper part of the class, we understand this thing. They call it accumulation, manipulation, distribution. Is like a technical term. So accumulation is when market is like ranging. People are buying and selling in between, in between. Then in, before you know it, it will break out and then start trending. Before you know it, it go back into range again and then start ranging. That is how price behaves. That's how price behaves. And the higher the demand, the higher the price. The lesser the demand, lesser the price. And green candles go up, red candles come down. They are open and close. You can see in the picture. So thank you all for tonight. So next class we will just go into the in-depth of candlesticks, their interpretation, and then we just go into strategy straight. Those strategies. I will just teach us one or two or three strategies, and then we are done, and then we can start trading. Thank you all for joining tonight. See you next time.
Thank you.
Thank you, sir.